Good afternoon. I'm David Mandy, President of O&M Partners, and I want to welcome you all today to the Town Hall for Generation Mining. Generation trades on the Toronto Stock Exchange under the symbol GENM, and they also have a OTC listing GENMF. This event today is brought to you by New York-based O&M Partners. We're in a marketing and communications company. We're in no way commissioned by Wall Street. We don't take any fees. We're just in the game. Our focus is on bringing the managements of public companies and investors together in real time, hoping this call will provide context for you and also we're hoping to answer some questions for you as well. Please feel free to chat in your questions through the question pane of the GoToWebinar or via email. And we'll be happy to get to your questions. If we don't, we'll get back to you after the call if there's not enough time. Pleased to have today presenting, before we turn to management, our host, Kerry Knoll, we have Chris Marcus today presenting kind of a larger themes for us before we turn to generation. Chris is the founder of Arcadia Economics. It's an Australian economics-based financial market research firm, helps investors understand and navigate the bubbles inflated by the Federal Reserve's monetary policy. Chris's background includes 11 years on Wall Street. He has an MBA from Wharton, 7 years as an equity options trader on the American and the New York Stock Exchanges. And then after having his eyes opened by the collapse of the subprime bubble, Chris left Wall Street to focus his research on hard assets, and particularly gold and silver stocks. And he currently hosts a financial show called on YouTube. So on that note, it's a real pleasure to turn the call over to Chris Marcus.
Well, thank you, David. I appreciate that. Certainly the palladium market is quite a fascinating one, especially with what's going on in the world where now we have unlimited quantitative easing out of the Fed. A lot of money is flying out there very quickly. And I think what you saw in palladium, here's the chart today. You see it's trading, let's call the midpoint 2100, 2150, down a bit today. Although for those who may be a little bit newer to palladium, it's had quite a rally over recent years. Here's a chart from 1992 to the present. You see it was around $100 back in the 90s, then had that spike up during the dot-com bubble, then comes back down, then had been around $400 to $600 an ounce before really in the last couple of years accelerating. You can see that's gone quite vertical. We'll take a quick look inside that. There you can see 2018 was $1,100, went down, finished the year higher. And then 2019 was really a big year, started at 1,300, escalated all the way up to 1,900. And earlier in 2020, we saw that rally continue, just continuing up, hit, looks like they marketed 2,800 here before getting sold off pretty thoroughly with everything else over the coronavirus sell-off in the last couple of weeks. Although what's interesting is that you see, let's say if we look from, February, March, sold off quite a bit down to 1,500, although back up to over 2,000. So certainly a volatile road. And I think what has happened here is that a lot of these metals, you have structural deficits and a lot of levered paper out there. This is something that I dig into quite a bit in the silver market, but certainly has happened in palladium. Keep in mind that with those recent Department of Justice confessions from some of the bankers that trade in the precious metals markets, one of them did include confessions of manipulation in the palladium market. And essentially what happens is that things get a little out of skew because they're traded in paper. So you can have physical demand, or rather contract demand, on the COMEX, which is the price we're looking at in these Kitco charts, but let's say the Fed launches, for example, unlimited quantitative easing, and you would think that the price of precious metals would rise in that situation, yet obviously we've seen that not happen many times. And that is again because you can sell, or not you, but a lot of the banks can sell as much paper, gold, silver, or platinum, or palladium as they want. So you've created a situation where the metal in many of these cases just isn't there. That appeared to be what was happening as there were actual physical shortages in the market over, especially this last, really look from 1400 in August of 2019, actually is double to the 2800 it was at earlier. Again, dipped down, but then rebounded. A lot of people were wondering if that would be what would trigger a similar situation in gold and silver. Again, I study silver most particularly, where the estimates I hear is for every ounce of physical metal, there are up to 500 people who think they own that in some paper form, whether that's COMEX contracts or EFPs or a whole variety of other technical gold and silver and platinum, palladium paper products, where you have this same concept you've heard so much about in recent years of hypothecation and rehypothecation, which perhaps to boil it down simply, just imagine multiple claims on the same ounce of metal.
So here we have the commitment of traders report for palladium. And basically what this shows you is a snapshot. And this red line in particular here shows you whether the commercial banks are long or short. So you can see back here in that same time period, we looked at August of 2018, or 19 rather, yes. No, this would be 2000. Okay, so here in August of 2018, you can see this red line. And if you look up at that yellow box, you see COT, DLC, and a C around it, 5 up from the bottom, negative 3,236 contracts. So that's the amount of contracts the commercial banks were short here. And now if you're looking at that same C field, negative 15,000, negative 14,000. Here they're going to get a little bit or less short. But you see, as the banks were getting short, the price is rising as they continue to get short. Then right here, as they've been covering, interestingly, you've seen the price drop quite a bit. This is a pattern that we see again in many of these metals, where if you just look at when the banks were long or short, you have a good idea into what's going on. And again, especially now, an interesting environment where, yes, you would expect industrial demand to drop quite a bit with what's happening with the corona. But the other part of it is that there is that precious metals component of palladium. And when you have the Fed printing over $500 billion a week, you know, people are going to be rushing to these metals. We've seen liquidity warnings issued by the London Bullion Market Association in recent weeks, similar with the CME and the COMEX. So basically what you had happening was people were wondering if we had reached that point where the metal just wasn't there, because you can write all the paper you want, but when we're talking about a physical product here that's actually going and used in industry, we saw the lease rates spiking, which means that people were not willing to lend metal. People wanted physical metal, and that's what was driving that. Obviously, things had a bit of a detour along with Corona, where the whole market sold off. But interesting to see that a good chunk of that has already rebounded. Again, let's see if we look at January, the price was around $2,000 an ounce. So palladium basically back where it started the year, which again, as you can see from this chart, is still doubled. Again, here is last August of 2019. So all these things with the markets, there's the individual aspects that are happening with the individual commodities, in this case, palladium. But when you have sell-offs in the broader market, or obviously things like the coronavirus, where you've seen everything get sold off, that plays in too. But certainly will be interesting to see what happens with the precious metals imbalance that the world is currently experiencing now, which really in the last month, bullion dealers have seen record sales of physical gold and silver. A lot of the mines have gotten shut down. In fact, Mexico last week announced they were shutting down anything non-essential, which included mining. Seems like they've been going back and forth on that, but you have a lot of mines getting shut down around the world, which is hurting supply and has really been pressuring this fractional reserve system, which is how things are traded on the COMEX and the LBMA. So certainly a lot of people in the precious metals world very interested to see how that plays out. If that leads to some sort of short squeeze or failure to deliver, in that case, you would likely see all of these metals spike quite considerably. But again, what's driving all of this? And again, you see palladium was rising even before the Federal Reserve resorted to unlimited quantitative easing. If we reach a point in the near future where the coronavirus settles down, especially with all the money that's being printed around the globe, it will be interesting to see if we resume this vertical rise up. Last thing I would like to point out here, you see how the palladium price has basically gone vertical. And normally in a stable environment, you would think, all right, why is this going vertical? But something to keep in mind, here's the US debt chart. This is from 1972, where the debt chart has gone vertical. And of course, here is the Fed's balance sheet. You see back in September of 2008 was about 800 billion. It never really was reduced as the Fed liked to promote the appearance of happening. You see it got up to 4.5 trillion, came down a little bit in the last couple of years, and then has just gone exponential. So again, something to keep in mind when you're looking at the prices of any of these metals. Just imagine gold, silver, or platinum in a simple way, just as a piece of metal. And if you double the money supply, then if nothing else changed, you would expect the price of the metal to double in a theoretical world. So there is a reason that these prices are going up. We'll see how it plays out, but certainly a fascinating situation and some things to consider in the palladium market.
Thank you, Chris Marcus. Chris, again, the founder of Arcadia Economics and also the author of the book called The Big Short. Pleased now to turn to our host, Kerry Knoll, who is the executive chairman and director of Generation Mining. Kerry has quite a background. He's executive chairman, director of Generation Mining, and is known in the industry as a visionary company builder. He's co-founded several successful mining companies over his 25-year career, including Wheaton River, which was bought by Goldcorp, and Thompson Creek, which was acquired by Centerra Gold. Kerry's track record proves that those who are successful in the mining industry, building one company, they tend to do it over and over again, and that's why oftentimes investors, the key to stock picking is actually picking managements. So he was a gold buff for the first 15 years of his career, but his greatest success came when he started focusing on the less sexy, overlooked metals, such as moly, lithium, zinc. But he found the most overlooked metal in palladium. Few in the investment community seemed to notice that palladium had already soared from $800 an ounce in 2018 to $1,200 in 2019. His instincts for value led him to the Marathon Project in Ontario, which is the largest undeveloped palladium project in North America. It's an absolute pleasure to turn the call over to Kerry.
Thank you. And thank everyone for coming on to the presentation. Those of you who have seen the presentation before, you'll have to bear with me because we have some new people watching it. So we're going to be going over some of the old things, but we're also going to update you on what we've been doing in these last couple of months and as well as the last year and a half. So I'm going to talk a little bit about our company and then extensively about our project. And I'll follow that by a little more detail on the palladium market, more on the fundamental side than the previous presentation. And then I'll follow up with the a little bit on the company and who owns us and who controls us, etc. So there's a disclaimer for you to read if you want to after the presentation. So generation mining really hit its stride last year when in July we acquired a 51% interest in the Marathon Palladium project in Northwestern Ontario. We also have an option to increase that to 80%, and we can do that by spending 10 million Canadian dollars on the project, and we've already spent 4, and we're well financed for the rest. So we're intending to go up to that 80%, if not this year, but by next year for sure. We had one of the first things we did when we got the project was to take the 3 deposits. There's a main deposit and 2 satellite deposits, and have an independent resource calculation on those. And we decided to go back to square one. We went back to the original drill results because had been a number of different calculations in the past, and some of them were different from one another a little bit. And so we decided we wanted to start from scratch, so we had our own database. And we confirmed that there was in excess of 8 million ounces in the measured and indicated categories, and another 900,000 ounces in inferred, which is a very large starting resource for a junior mining company. The property is especially well located for a mining property. We're near highway, we're near rail, we're near power, we're near a town. So we've got a lot going for it that way. And to summarize our last year of work, we managed to complete within 6 months of acquisition a preliminary economic assessment on the property, and the numbers are very good, and we'll go over those numbers in a little while. Also, we're well financed. We're still trying to get a handle on our budget for this year, getting quotes on what the feasibility study, we're doing a feasibility study this year, getting a handle on what that's going to cost. But we're looking in the $2 to $5 million range, probably somewhere halfway between those two numbers, and we're well financed for that. We've got 14 million in the bank. One of the good things is, and we mentioned that in a release that we put out this morning, is that we're now at the stage of a company where we're not doing a lot of field work right now. Right now, the work we're doing towards a feasibility study is done from a desk. People are working from home. Our consultants are working from home, and we're doing a lot of advancing of the project through this. The only field work we're going to probably have to do in order to complete a feasibility study is we may have to do a little bit of infill drilling. We may have to do some condemnation drilling on the property. Those can probably be done late in the year. And then the other thing is we may have to do a little bit of lab work. We want to try and improve the metallurgy, which is already good, but we want to improve it further. So we need to probably get back into the lab. And again, that's something that we would probably be doing later on in the year. This is a breakdown of the metals on our property. As you can see, it's mainly a palladium project. But that said, we do have platinum, we do have a bit of gold, and we do have 1 billion pounds of copper. And if you look at the demand for those various metals going forward, and I'll get into where they go, but palladium and platinum are both used mainly in catalytic converters, palladium for gasoline cars and platinum for diesel and diesel trucks, etc. And of course, copper is a big component of electric cars. So depending on however way the market for vehicles goes, I think we're we're pretty much covered. This is a map of northwestern Ontario with the location of our project outside the town of Marathon. As you can see, we're in a big mining area. There's mines dotting the shores of Lake Superior on all sides. It's something that was once called the Mid-Continent Rift, when a billion years ago the continent was trying to rip itself apart, and that resulted in a lot of magma coming up, a lot of lava coming up, and the formation of a lot of mines. And that never did split the continent, but it resulted in a lot of different mines, and our deposit is in the heart of that. A little more detail on our property. We've got a very large property. It's over 200 square kilometers. That would be 50-60 square miles. It's located, the Trans-Canada Highway goes right through the property. The CPR main line goes right by the property. We've got a town near the property that was 3,000 people, but it was 5,000 people. A lot of empty houses there. The town supplies the Hemlo Gold Camp, which is a very large and very rich gold camp about 30 kilometers away. And that camp is winding down. It's been going for 35 years and it's got about 10 years left. And the workforce has been reduced, and as a result, the town is hurting a little bit, and would really welcome us to reopen or to open a new mine. We've also got a number of native groups in the area, and we've been talking with them and negotiating cooperation agreements, and so far so good. They're proving to be a very professional bunch to deal with, and we're quite happy to be dealing with them. One last thing is that previous people who've looked at the feasibility of a project here have been hamstrung by the lack of power. There was not enough electricity to operate a mine of this size, and therefore they would have had to look at bringing in fuel and generating their own power, which is expensive. But starting last fall, the government of Ontario is financing a $1 billion power line going across the north shore of Superior from Thunder Bay to Wawa, and that power line is going right over our property, and it's 230 kilovolts. We'll have all the power we can possibly use. So again, that's another big benefit from this property. And you don't see very many new mines start up that have the access to infrastructure that we've got here. A quick history of the property. It was developed over 35 years by a lot of different companies. Finally, in 2010, there was a feasibility study done, a company called Marathon PGM, and that was sufficient that American company called Stillwater took it over for $118 million US and managed to sell 25% of the project to Mitsubishi for $81 million in 2012. But palladium prices were low. Looked like the capex was going to be higher than they thought, so they shelved the project in 2014, and it's sat there until we came along. Sibanye Gold acquired Stillwater in 2017, and again they did a little bit of work on it, but very little. And so finally in 2019, we came along and purchased the property from Sibanye, who doesn't have a history of building mines. They're more of an operator and an acquirer than a builder, and they've done a good job on that. And so we can now get our interest up, as I mentioned, to 80%. Sibanye does have a back-in right. They can buy back 31%, bringing their total to 51%, but they're going to have to pay 31% of the capex to do that into the joint venture, and that's we're talking well in excess of $100 million to buy that 31% back. So very expensive. We don't think they're going to do it, but at a certain palladium price, it's possible. But what that does is bring our share of the capex way down to we could wind up owning 49% of this project for only putting up about 33% of the capex. So that would not make us unhappy either. As I mentioned, we did a PEA, and that was released in January. The PEA only looks at about a third of the mineralized material on the property. It does not look at either of the satellite deposits, and it does not look at the deeper ore on the main zone. And I'm not allowed to call it ore, I'm sorry, but the deeper mineralization on the main deposit. It's look, and just that 1/3 of the mineralization has a 14-year mine life, producing an average of 194,000 ounces of palladium equivalent per year. And the capex for that is about 431 million US or Canadian, which is about $320 million, or probably around 300 million today, US dollars. That's an affordable number for a junior mining company. I've built a number of mines in my career at that level. It's not out of our reach. The numbers show, and this is at a $12.75 palladium price, and realize that palladium is trading at over $2,000. It did recently have a dip to $1,500, but at $12.75, we have an internal rate of return of 30% and a net present value of 871 million. That's one ratio I'd like to point out, is that's double the capex, and you do not see very many mines, especially at a much lower metal price than it's actually trading at, have a net present value that is double the capex. And that just shows how robust this project is. At spot prices, and this was spot at 2019 when palladium was trading around trading right around what it is today. Our internal rate of return is 45%, and the net present value is 1.5 billion. So getting close to 4 times the capex. So it's a very, very robust project. Our cash operating cost is looking around just over $500 an ounce. Our all-in sustaining cost, it's not on this slide, is around just under $600 an ounce. So at any reasonably foreseeable palladium prices, this project is going to make a nice profit. And I just added this slide for this presentation just to show you guys what happened when we announced in January the results of the PEA. And the stock went from about the low 20s all the way up into the 70s, more than tripled. The volume increased 500%. So the market really paid attention to this going into February and really into March. The share price was still pretty good, but of course with the virus, first of all, the quick decline in palladium price from about 2,800 down to 1,500, and then of course the junior mining stocks have been hit. But I will say that we did a financing in that time in January, closed around the end of January, of just over $10 million. And that was done at 52 cents a share. So, and some very smart people participated in that financing, and I'll talk about that a little bit later. So you do have an opportunity to acquire shares at about just over half of the price that some very smart people did in January. This is what the deposit looks like. Along the borders here, this is the pit outline, the jagged line you see there, and the red stuff represents the mineralization that we'll be mining. And that's why you can see that this has what's called a low strip ratio. For the amount of waste we have to take for every ton of ore, it's only about 3 tons of waste per ton of ore, which is a really, really good strip ratio, which is one of the reasons why this project is so robust. And this is just a map from a drone view showing what the layout is going to be. The access road on the very bottom of the map there is the road into town. It's about 5-6 miles. That's 8-9 kilometers. Here's where our plants are going to be. The gray area is where all the waste rock is going to go, and that's fabulous because it's right beside the mine. We don't have to haul it very far, which is a nice benefit. We're going to have 3 pits, 1 little pit in the middle and 2 other pits on either side, and we're going to put the tailings in a little valley just about 2 kilometers away to the west. Even though the numbers in our PEA were very good, we have opportunities to make it better. And a lot of that will depend on the metal prices. A lot of that will depend on the additional engineering that we do. We could, for example, go deeper. In the main deposit, there's 90 the way it's planned right now, there's 90 million tons, or about 50% of the material is left behind. So with a higher strip ratio, we could go deeper. So that's a possibility. We've also got 2 other deposits, the Sally and the Geordie deposit, which have 1.5 million ounces of indicated and almost 1 million ounces of inferred. Those are not included in the mine plan. Those are going to get mined. At the end of the mine life, they're about 20 kilometers away. You're going to haul ore over to the mill and just continue mining. We've also had the possibility of locking in a higher palladium price, especially for the payback period. I didn't mention in our PEA results that the payback in our PEA was 2.5 years. And if you look at spot prices today, the payback is under 1.5 years. So if we could lock in a higher palladium price with some end users, because trust me, end users out there, which are the car makers, need palladium. They cannot make a car with palladium, and if they don't have the palladium, so they might be willing to lock in a price at around spot for a couple of years at around the time we're going into production if palladium is still in deficit, and we expect it to be. We're going to be doing more metallurgical test work. The last work was done 8 years ago, and we think that we might be able to improve on what we've got. We're looking at about 81–82% recovery of palladium right now, and it would be nice to bump that up a few percentage points. For financing the CapEx, we have the option to sell a royalty, to sell a stream. There's a lot of streaming companies out there now. Some of them have been contacting us about this. There's no existing royalties on the property, so that gives us some flexibility. We also produce in our concentrate, we produce a little bit of something called rhodium, which has been bouncing around. It's traded as high as $11,000 a gram, or sorry, an ounce, which is about $300 a gram. Currently, we assume we're going to get $0 for the rhodium because in our initial talks with the smelters indicate that they don't intend to pay us for the rhodium, but we know they recover the rhodium. And if you're getting $300 a gram and our cost of transport and smelt the concentrate is less than $300, and they're getting $300 just from the rhodium, we'll be talking to them about that. And no guarantees, but there's another possibility. And of course, it's a big property. A lot of it has not even been explored at all. A lot of it is under overburden. So our kind of goal is not to try to find more tons of what we've already got, but to look for some higher grade, and we've got some opportunities there that I'll talk about shortly. So the palladium market, as you saw in the introduction there, is increased dramatically. Most of it is now used for auto catalysts, even though it's a precious metal, and it remains a precious metal. And it was used big time in jewelry at one time. It's now become an industrial metal for the purposes of the automobile industry. And a typical car uses somewhere between 3 and 7 grams of palladium. And the 3 grams is on the side of in the countries where they have looser pollution requirements, and the 7 grams is in the countries where it's stricter, and that mostly applies to the bigger vehicles like SUVs. But the loading per vehicle has been increasing globally. And the reason for that is because in the last couple of years, Europe and China have both increased their restrictions to match similar to what you've got in North America in terms of how clean the air's got to be. And what it does is the palladium scrubs out nitrous oxide and carbon monoxide, both toxic, and that's their use is required in cars in virtually every country in the world. The annual demand of this material is about 11 million ounces, and you've only got about 7 million ounces coming from mines every year, and that's been falling actually the last couple of years. And there's another little over 3 million ounces coming from recycling, but depending on who you talk to, there's a deficit of between 1 and 2 million ounces was planned for this year, 2020. We don't think that's going to occur now with the virus, but interestingly, the mines in South Africa are mostly shuttered right now, and so the supply has been drying up. The demand has been drying up as well. However, China has now been reopening its automobile factories, so the demand is picking up there. So we don't know exactly, nobody knows exactly where the supply and demand is going to be right now, but I think at some point it's going to fall back into what it's been doing the last few years, and that's being in a deficit. And this slide really tells the story best. If you look on the left hand of the slide, that's from 2000 to 2010. The market was in surplus. And then slowly more and more palladium got used in each car. Obviously manufacturing went up in numbers for the last 10 years, has leveled off the last couple of years, but nevertheless, the loading per automobile has gone up, and that's what's made palladium go up. It was simply in a shortage, and it did have a big spike down and then somewhat of a recovery, but it really is in a solid deficit, and it's not going away because of the virus. People will, if you have a restaurant right now and you're losing customers or you don't have any customers, you're not going to ever get that money back. But car manufacturing is different. If somebody was going to buy a car 3 months ago and they're waiting, they're going to eventually buy that car. So the car, we see there being some pent-up demand when this is over and everybody gets back to work. And just a couple of other points. There is very little new production coming on. We can only identify 3 mines over the next 5 years. Norilsk is a big one, 1 million ounces, but still that doesn't quite even cover the current deficit. Platreef is talking about 200,000 ounces per year starting next year, the year after, something like that. And then there's a small one in Russia by a company called Eurasia. And you're still getting double-digit growth in platinum consumption due to the increased loadings in cars. So we don't see the situation changing anytime soon. Sibanye and BASF recently came out. They're big. They have a joint venture that manufactures catalytic converters for cars, and they recently came out saying that they've come up with a new one that is using some platinum now, and instead of all palladium. Platinum's cheaper, but of course, if you start substituting platinum, already a third of the platinum is already going into catalytic converters. If you were to double that, I think you're going to see a gain in the platinum price, and so palladium will probably come down a bit, platinum will probably come up a bit, and they'll meet somewhere in between, if that happens. But that's still going to be several years away. One of the things that some of the analysts have done is compared us with other precious metals developers, mainly gold. And this is a chart of a bunch of the Canadian or at least gold developers that have good access to infrastructure and capital. These are solid companies. And if you look at them, they average $72, and this is a bit out of date now, but $72 per ounce of gold in the ground, whereas we're trading at $7 per ounce of gold equivalent. So we would have to go up 10 times in price just to match these guys. If you look at us comparing with the palladium developers, and that's the one thing, there really aren't very many palladium developers in jurisdictions that you really want to invest in. And by far, we've got the largest resource of any of them, but we still don't have the largest per ounce. And this is in February. I think our number's now around $4 per ounce, and probably some of these other ones have come down as well. But the point is that we have a lot of room to move even to get up to the average. So what are our plans? Well, I'm proud to say that we did everything in 2019 that we said we were going to do. Some of it didn't get quite done, and it went on into 2020, but we got most of it done. And in 2020, we're looking at a bunch of things. One is we are looking at a new listing. We made some applications in the late 2019. Unfortunately, they've all gone on hold because the listings people at the exchange where we wanted to go, which I can't mention, but they're all at home. So we're going to have to wait till this is over. And but meanwhile, we're confident we're going to get a much better, much more solid listing. We want to start the permitting, and we're going to be starting that hopefully around the time we start our feasibility study. And both of those we're expecting to start in the current quarter that we're in. What we're doing on the feasibility studies, we're doing, as we mentioned in the release this morning, we're doing a number of trade-off studies, and those are just little studies to try to figure out what is the best way to go on, size of the mine or, strip ratio, different things like that. And then by figuring those out, we can save a lot of money and time on the feasibility study. So that's why we're doing those now, but we're expecting those to take a couple of months at the most, and then we'll be moving along from there. Management team, I'm really proud of the team we've assembled for this project. I've been working with Jamie for several years, and as they mentioned in the introduction, I've founded quite a number of successful mining companies. Jamie and I have been working together for 8 years, and our last deal was Pine Point, which we were just getting ready to start the feasibility study when Osisko Metals took us over, and we spun out Generation Mining from that. More recently, in January, we hired Brian Jennings as our CFO, and Brian's very seasoned. He's not only a geologist, but he's got extensive financial management and was very senior in Ernst & Young. Just last month, we hired Drew Anwell, and are very proud and happy to have Drew join us. Was senior vice president at Detour Gold. He was at Detour right from almost the very start, from when Detour started, started building the mine, and was there for almost a decade. And you know, as you probably know, Detour got sold last year for nearly $5 billion. Previous to Detour, Drew was at a mine for Barrick and in Papua New Guinea. Also one of the largest, these are two of the largest open pit gold mines in the world, and he's been working at them both for a long time, so we're really happy to have him join us. Rod Thomas is a very well-known exploration geologist in Canada, worked with BHP for years and a lot of other companies. He used to be president of the PDAC. So those are just some of the people. You can read about the rest of them, but we got a really good crew here. And we've been building up our independent directors since this all happened. So we've had 3 new directors join us. On the left bottom there, Paul Murphy, who's Paul used to be head of the whole mining group for PricewaterhouseCoopers. He's current chairman of Alamos. He was chief financial officer of Guyana Goldfields. Cashel Meager has joined us recently. Cashel's the senior vice president and chief operating officer of Hudbay, large mining company. And Phil Walford. And Phil's interesting, his connection to us, because Phil was the CEO of Marathon PGM back in 2010 when Stillwater bought it. And he spun out a company called Marathon Gold, which he ran for the next 10 years until he retired. And they just came out with their pre-feasibility study this week, and the numbers look very good. So he's done this before as well. So we've got 127 million shares outstanding, fully diluted 161, gives us a market cap of about $38 million at recent prices. Our key shareholders are really a who's who in mining. We've got Sibanye, who's the largest platinum producer and the second largest palladium producer in the world. They own 8.8% of us. Lucas Lundin, a mining legend, a billionaire, owns about the same amount. Osisko Mining, which participated in the last financing in a large way, owns 8% of us. And Eric Sprott, who was half of the last financing, and Eric Sprott's another mining legend, owns 7.7% of us. And management and directors own 6%. And I'll add to that Jamie and I and the other directors and officers that own shares own them because they bought them at the same price of everybody else. We've participated in every financing that has happened since inception, and we got our shares at the same price as everyone else, which is not that common in our business, unfortunately. And I'm just going to leave you with a picture of this rock. And this is a rock that was found on our property in, I think it was 2016. It's more than 100 times richer than the ore that we're mining. And we're not sure exactly where it came from. We're looking. It would be lovely to find the source of it. It's one of the exploration puzzles that we are hoping to work out. And there's no guarantee that we can find it, but if we did, it would be a very, very rich deposit. It's one of the richest palladium samples ever found. Plus, it's got 9% copper on top of that, so pretty rich. So that's that takes us to the end of the presentation. I think we're in good shape time-wise, and we can start doing some question and answer.
Oh, are we good? Does that sound good? Exciting, right? Hi, it's David. Okay, back. Great job, Kerry. Great presentation. We're going to go to Q&A, and we're going to start with Chesley Morton. Chesley, good to have you on the call
Okay,
today, Chess. Questions?
good to be here. With regard to your graphic about the proposed open pit, you show mineralization on one side. Is that I'm assuming that's the palladium, but is it all the other contained minerals as well, or would they be represented in what essentially is your waste rock there?
No, the minerals are all found together. In the main zone, there are kind of two zones within the main zone. One of them is just about only PGMs. The other one is where the copper is, and the other one is by far the largest one. So the copper and the PGMs are all occur together.
Okay, and in the early days when this was kind of shelved because it wasn't economic, was that because of palladium prices being around $200, and wasn't platinum at that time, and you've got 1 million ounces or so of that, wasn't that riding high at the time?
Yeah, so if you did all the numbers, the basic number you look at the end of the day is called the net smelter return. So it's the amount of money, cash you get from every ton of rock that you buy, and then you weigh that against your cost of mining it and processing it. So we're looking at a cost of about $21 a ton to mine and process, and we're probably getting $50 to $60 in NSR depending on your price. Back then, the NSR was probably around, I'm trying to remember, $36, $38. And it wasn't enough of a margin to justify the CapEx, and that's why it got shelved.
Okay, that's interesting. And finally, you know, you've pointed out the volatility of commodity prices. Do you think that you or whoever puts this into production would either desire or be required to hedge?
Well, first of all, the first question is, can you hedge palladium? You have to probably go through to the end users. There's not like gold or silver, a big market that allows you to easily hedge. So assuming that we can find some end users that are interested in hedging, our interest, depending on the price the day that we want to do that, is to lock in a price where we're going to be pretty much guaranteed getting all of the CapEx back at a good palladium price. And if we can do that, we're going to do that. But I can't tell you, during our construction period what the palladium price is going to be. But if it's still north of $2,000, we're going to be working really hard on it. And there's a couple of firms that are traders in palladium that we've met with in Europe, and one in New York, that have told us that they believe that they're the ones who buy the palladium from the refineries and sell it to the end users. And they've told us that they think that they can probably find some of the end users. There's more than 60 catalytic converter manufacturers in the world, and some of the smaller ones are actually very concerned not only about the price of palladium, but if they can get it. If they can't get it, if there's a deficit and they can't get it, they can't produce. They have to shut down their production line. So, and back when I was in the molybdenum business, that was the same problem with the steel makers. They were concerned that they couldn't get enough molybdenum, and they were going to have to shut down their whole production line. So for the sake of a few dollars, we think that we're going to find someone willing to hedge, and we're willing to. But I don't think we're going to go out beyond the payback period, because I think the market, the investors want to see the upside if palladium were to go up further.
That's perfect. Thank you very much.
Thank you.
Thanks, Chesley. Thanks for your questions, Chess. Marshall Barrell, are you on the line with us? Okay, we'll come back. Doug Loud is on the line. Doug, question, please. You have a question?
Hi there. This is very interesting. Since you're in an existing mining kind of an area, how long is it going to take for the permits and to actually get going?
Well, that's the $1 million question, isn't it?
Yeah.
So Our best estimate on permitting, and I should get back, I didn't get into it in the presentation, but Stillwater, when they were getting ready to build a mine there, and they started the permitting process in 2012, and they worked hard on it for 2 years. They did all the studies, and very fortunately, Stillwater and then Siboney kept those studies live by updating them every year, which is really helpful to us. We don't have to redo them. So the permitting process was started, and it got 2 years in, and then was halted, but it was not canceled. It was only postponed. So we need to restart it. I don't think any mining company can tell you exactly how long a permit's going to take, but we're guessing within 2 years of when we restart it. And we think that possibility is it could be a little sooner than that. We've had some discussions with the Ontario government, and you're probably not aware of the politics in Ontario, but a new government, the Conservative Party, was elected in about 2 years ago, and the Conservatives have, one of their mandates is to speed up the process of mining. And we met with some of their representatives. We're going to be meeting with more of them. They want to know what they can do to help us. And it's not to reduce the amount of technical work we have to do or change any of the permitting requirements. We're only talking about speeding it up. Only saying instead of them having 90 days to reply to an email, they maybe should have to reply in 10 days. Things like that that can just speed up the process. And so we're hoping to do that. One of the new Premier Ford's first public things that he did was go to a mine opening in Ontario and say that, well, we want to speed these things up. So we could beat that, but I think to be fair, we should probably think about 2 years.
Okay, great. Thank you very much.
But that said, there's a lot of things you can do to get ready to start building the mine when you're getting near the end of your permitting. You can put roads in, you can do all of that stuff while you're waiting for your permits. And a lot of mining companies do that.
Do you really want to build the mine, or would you like someone to come eat you once you have your permits?
Well, I've started 6 mining companies in my career. 4 of them have gotten into production. 1 of them got to feasibility before it got taken over, and 1 of them got to PEA before it got taken over. So I'm good either way. I like building them, but if somebody wants to pay up, we'll look at it.
Great, thank you very much.
Thank you, Doug. As always, pleased to have Jeb Handwerger on the line with us. Jeb's done some introduction for us. Jeb, a question today for Kerry?
Hey, Kerry, thanks. Great presentation. Where would you rate this project versus other companies that you've been involved with and other versus other peers? And how would you value this, like a Palladium stock versus the gold valuations? I know that you have, if you showed what you'd be valued if you were a gold producer. I know there's a little bit of a Palladium is kind of not valued the same way. If you could discuss that.
Well, there's a couple of different things, and I've got my opinions, and some people here may have different opinions. But as far as comparing to projects that I've had in my career, the best project I ever had in my career was a mining company we acquired that was already in production. It was called Thompson Creek, and famously our shares went from 10 cents over 2 years to $24 a share. We were Kramer's top pick, and we were making $1 million profit a day for a full 2 years. So that I don't think I'll get another one of those. But as far as an undeveloped project, this is the best one I've ever had by far. The numbers are I mean, when you have at spot prices, at today's price, when you have a 45% internal rate of return, I mean, that's phenomenal use of capital. So I don't think there's very many better ones. I don't think that there's a better Palladium project, undeveloped Palladium project in the world. And I would ask you to show me one if you think you have one. As far as how we compare to golds, well, Palladium is not gold. It's a precious metal, so you've got a bit of a safety net there if for whatever reason car manufacturing stops, which is not, but if it did, then it's still a precious metal. And it was used extensively in white gold for many, many years, palladium, because it was considered, it was cheaper than platinum or gold at the time. What should we be valued at? Well, I think that typically a developing company, and let's talk base metals then, if you don't think we're, for the people who don't think palladium's a precious metal, they still tend to trade at 25 or 30% of their net asset value at the PEA stage. And with our number at $800 million, that would give us a $200 million market cap against the 38 million that we have now. So that, and that's kind of that 25% is kind of a typical number that you're going to see pretty much across the board in the base metal mining industry, or the uranium, or some of those commodities. So I think we have a lot of room to move. We were just getting the momentum going when the virus hit, and you know, we had 22 cities lined up around the world that we were going to be marketing the company in, and we're going to be getting back doing that as soon as this this winds up, the virus, and you know, the world becomes a safe place again.
Thank you, Jeb. We're going to turn next to Murray Vanderbilt. Murray in Boston. Question today, Murray?
Yeah, Kerry, do you hear me okay?
Yeah, we can hear you, Murray.
Oh, great. So obviously we all try to get our arms around how COVID might affect things. And my thoughts are generally 6 months to a year. Hopefully we'll be somewhat back to normal, but the palladium price has been very volatile, as you know. One would assume that demand for autos is going to be way down for the next 12 to 18 months. But then I guess, and I'm just rambling here, pin-up demand will come back. But what I'm really trying to get at, if palladium holds at the $1,500 or $1,300 plus, or is there, when you get into production, it seems to me that the numbers here are so good that I can't understand why Sibanye wouldn't automatically just come in and repurchase their interest, and prior to some other large guy coming in to take you out. I just wondered what your comments about that might be.
Well, I can't. First of all, I can't speak for Sibanye for what they're thinking. But putting myself in their shoes, I would think that number one is Sibanye has not been in their since they were formed, have not been a mine builder. They've not built any mines. Number one. Number two, they're making right now, or when their mines reopen, an annual about 4 million ounces of platinum, palladium, rhodium, and gold. This at 194,000 ounces a year is less than 5% of that. So it's not going to move the needle for them. Third one is that means they have to come into Canada, open up offices, build a mine in a country they've never operated in, and again, for what? For what end? They're going to have to write a check for $430 million, and they're going to get less than 5% increase in production. So that's why I don't see them doing it. But you know, I can't say. And if we happen to discover a rich deposit, or if we happen to get a $3,000 or $4,000 palladium price, they may well come in. But as it is, I don't see them doing that. But again, I can't tell you what they're discussing at their boardroom table. I'm sure we're not a big topic of conversation there, because it's just small for they're looking at they've stated that they're looking at acquisitions of at least 1 million more ounces per year.
Okay, well, the other thought is you're talking 2 years permitting. Even if you speed it up, you're going to have the delay because of the COVID. So let's say two years works. You do some preliminary work, but it's open pit, pretty straightforward, good location. So do you think you could, after the permitting's in place and you feel comfortable that you could be pouring metal a year after you get the permits, or is that too aggressive?
Well, it depends on how much preliminary work we do and how much preliminary work we're willing to do. before we have our permits and how the permitting is going. But I mean, I've had situations where I've done no work before the permits because I wasn't sure. That was when I was building a mine in Costa Rica, but other times I've done a lot of the work before the permit. So, but realistically, let's be honest, we're looking at an 18-month construction. So 2 years plus 18 months.
All right.
We're probably talking about realistically.
Fair enough. And your pre-feasibility was going to be Q1, I think, 20. Obviously, that's put off, even though you guys are working at home. But do you think, what are we talking, maybe third quarter this year? Is it a reasonable time, Tame?
So we're as I mentioned earlier, we're doing some trade-off studies. We're going to be announcing who is going to be doing the studies, and it's going to be a number of firms will be doing various parts of the study. And then we're guessing 7 to 9 months from when we start it. So we're hoping to start it in May, and we're hoping to be finished, you know, if not by Christmas, by early in 2021.
Okay.
But we plan to restart the permitting before that. The permitting, as I said, is already 2 years in, and we think we can start that around the time we start the feasibility study, because at that time we'll know the size of the mine.
Okay, helpful. Lastly, do you know of other mines that are keyed up aside from Ivanhoe Platte Reef, which is pre-COVID was going to be in production late 21? Are there any other sizable palladium guys that you know of that are on the horizon to be into production in the next couple of years?
Well, I mentioned earlier that there's an expansion coming in Norilsk that's going to be ramping up to 2025. That's the big one. Platte Reef is going to be about the same amount of palladium as us. There's a company called Platinum Group Metals that has done a feasibility study on a very large platinum, palladium, nickel copper deposit in South Africa that could come on. The capex is high, but they could come on, and you know, that might. But I think they've got six or 7 years to full production because it's deep and it's underground and it needs a lot of work. And then the only other one I know of is called, the name escapes me, it's in Finland. There's a fairly large open pit deposit. It's a little better grade than us and a lot more tons. It's owned by a private company. It's called, I don't remember it. Anyways, the company's Capital One out of London, England, that owns it. And they are doing studies on it right now. I don't know what stage they're at. They're keeping their cards close to the chest, but that one at some point will be sold probably to a public company, and somebody will be building a mine there at some point, I expect. And it's probably a little further out than ours, but still, nevertheless, it's that's another one on the horizon. And those are the only ones I know of any size. There's lots of, you know, 5 and 10 million 5 and 10 million ton deposits, like around 1 million or 500,000 ounces, those kind of things, and they're not going to make much of an impact on the world market.
Thanks very much for your time.
Okay, thank you.
Thanks for your questions, Murray. As always, they're great. We'll turn to Michael Potter. Michael, today questions?
Hi, Kerry. Thanks for a great talk. At what stage and how do you think you'll start looking for some higher grade material?
Well, we already started looking last summer. We drilled 12,000 meters, tested a bunch of targets. Unfortunately, didn't have any luck. We got a lot of smoke, a lot of places where we need to follow up that we think we might be close to something. We don't have a program plan for this year because we want to figure out whether we have to do any infill drilling as part of the feasibility study, and we want to hang on to some of our money because raising money in the mining space might be difficult in the next year. But that said, we have targets, and we will probably drill some of them this year, but we have not put together a budget yet or decided exactly where we're going to drill.
Okay, thanks a lot. One other question. How long will the cash you've got last you if you've got to sort of be careful how you use it before you look at raising more money?
Well, a good question. As part of our listing application, the exchange we're talking to said we needed to have 18 months of working capital. So we did a very detailed budget for the 18 months, and that left us with about $4 million after 18 months, assuming we do our permitting, get the feasibility study, all of that stuff done, all our burn rate. So I'm guessing it would be around 2 years.
Okay, sounds good. Thanks a lot.
Thank you.
Thank you, Michael. We'll turn now to Nino Scalamandre. Question today, Nino?
Thank you. Well, first of all, thanks for the presentation, but I know you had a little bit of a discussion about the price of palladium, very volatile, thinly traded. I think it's a 5% spread between the bid and ask. But how do as cars transition into electric, are you hopeful that the loss of the utilization in the catalytic converters will be put into fuel cells or something else? I mean, how do you account for increased demand in the future?
So we've looked at that hard, and we looked at that hard before we even got into the business. And there's a lot of different things at play, as you know, in the car business. So we looked at a lot of studies that said, what's 2030 going to look like for electric cars? And the best numbers we could come up with were like from Deloitte or from JP Morgan, and they're looking at numbers like 15%, 10% of the total car manufacturing being electric by then. Interestingly, they talking about 30 to 40% or even 50% of the cars to be hybrid by that point. Well, interestingly, hybrids need more palladium than the current gasoline cars. And the reason for that is because palladium only starts converting the carbon monoxide when it gets heated. And as you know, hybrids don't burn as hot as a regular gasoline car. So they need up to 7 grams for a hybrid. That's why, by the way, with all the thefts going on of catalytic converters around the world, and there's a lot of it, they're targeting the hybrids because they have the richest loading of palladium. So we think that any electric car is going to be offset. Any electric car decline is going to be offset by an increase in the uses in hybrids. Number one. Number two, on the copper side, if let's say 30% of the cars are electric by then, well, I'm sorry, we don't have enough copper for that. So we're going to be looking at, and we have 1 billion pounds of copper. So we're going to be looking at an offsetting increase in the price of copper. So that's and then the other one is the hydrogen fuel cells use even more palladium than the current gasoline cars. So kind of whichever way we go, I think we're covered.
Okay. Do you care to make any prediction on the price, say by 2030, based on demand curves?
It'll depend on a couple of things. Up until 2025, I think I can go, and I think that we're going to be in the $1,500 to $3,000 range. Beyond that, it'll depend on what mines get built. Norilsk is the big question mark. Norilsk is big. They're talking about expansion plans going all the way up to 2040. So if they continue on those, but we're talking about $25 billion as well. So they don't have that kind of money. So it's a question mark. We can't really answer beyond 2025. But the plans have been announced up to those years, and I think we're pretty solid up until then. I don't really think anybody can go too much beyond that.
Okay, thank you.
Thanks for your questions, Nino. Scott Edmonds. Scott, any questions from the audience? Time for a few? Is that all right?
Not today, actually.
Okay, so we're all good. Is Marshall on the call with us? I think we're good. Okay. We'll turn back to Doug Loud. Doug, I just want to ask you, you've heard the whole question, Q&A, anything that we're missing? You can unmute Doug and ask him to help. Doug?
That's sort of the right answer for some of the trickier questions about the coronavirus.
I'm sorry, Doug, couldn't quite hear you. Oh,
Sorry, I couldn't hear the question. Something about the coronavirus.
Yeah, I couldn't quite hear him. I put him on the spot. I'm sorry. Okay, well.
I'm right here. Can you hear me?
Yeah.
Okay.
I said it's even more interesting because your explanations of what happens with the coronavirus and changes in car production with the hybrids and the regular electric cars. I don't think a lot of people understand that more palladium may be needed rather than less, along with much more copper and other good things that you have.
Thanks, Doug. Kerry, wish to comment?
No, I think that says it. It's I think from what I could hear.
Thank you. Thanks, Doug. So Kerry, we'll turn to you for just closing remarks.
Other than thanking everyone for coming out and hearing the story, please feel free to reach out to us if you've got any questions. And in the future, you can email me, you can email Jamie, our president. And just thanks for coming out. It's a good project. It's a good time to buy it. It's on sale, as they say. I guess a lot of other things are too.
Kerry, thank you so much for presenting today, and I appreciate everyone's attendance and wish you a very pleasant afternoon and evening. Take good care.
Thanks, guys.